Hello everyone, my name is Lamarr Baxter, the Business Development Manager of AccuPlan Benefit Services. I'd like to thank everyone for joining today's webinar. Today's topic, we're going to be covering the topic of understanding unrelated debt finance income tax, also known as UDFI, as well as unrelated business income tax, also known as UBIT. Today's topic is something that a lot of our clients, as well as tax professionals, usually kind of have a hard time grasping the concept, what it is, when does it apply to a self-directed transaction, and what are some of the loopholes as it relates to avoiding some of these taxes based on some of the structures of your investments as it relates to using a self-directed plan. Just kind of go over what we'll be covering, as I mentioned earlier. This is regarding unrelated business income tax and unrelated debt finance income tax. We'll distinguish what the two are and how they apply to different transactions. Many considering investing using self-directed plans have heard about UBIT as well as relates to unrelated business income tax, and UDFI as relates to unrelated debt finance income tax, but unsure of what it is and when it applies. Therefore, we have invited our guest speaker, Lorraine Evans, who's a licensed CPA who's very well versed when it comes to self-directed plans and various aspects of the tax code regarding self-directed plans. With many investors seeking to invest in real estate with their retirement plans and considering debt financing as an additional capital source with a non-recourse loan, to aid in such investments, understanding how UDF applies to these transactions is a must. Therefore, it's important to understand how this tax is calculated and which deductions can be taken to reduce this tax liability. If you're also looking to seek to invest in a business or purchase a business with a self-directed plan, your profits may be subject to unrelated business income tax. So it's really important to understand, once again, if you're going to use a self-directed plan, that this tax could be a source, or should I say something that you'll have to be worrying about as a form of taxation using the self-directed plan. Just kind of give you an idea of how the structure is going to go. I'm going to have Lorraine speak about this UBIT and the UDFI, and then what I'll do is talk about the self-directed plan. We'll kind of tie everything together to kind of give you an understanding of how the transactions would work and how these two taxes may apply to a transaction. The webinar will be approximately 1 hour long. The first 30 minutes, Lorraine will speak, and then the last 30 minutes or so I'll speak, and then we'll leave a portion of the balance of the time for a Q&A session. This session will be recorded, so in the event that you have to leave, or if you want to pass this information along to someone else who may be interested in what we're going to be talking about today, there'll be a playback link emailed out to all registrants to forward along and to listen at their leisure at a later time and date. The text, or should I say the chat feature, is how you're going to be asking your questions. So we'll answer the questions, as I mentioned, towards the latter 10 minutes of the presentation. Any questions that we cannot answer, feel free to give us a call after the presentation and or email us, and we'll be happy to respond to you as soon as possible. Before we get started, I'm going to go and read over our disclaimer, because our objective is to provide education and not to steer you towards any type of investment advice or to give you any form of tax advice. And with that being said, I'm going to read off our disclaimer. AccuPlan Benefit Services and its affiliates do not provide any investment advice or endorse any products. All information and materials are for educational purposes only. All parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. So with any self-directed plan, we offer the investment vehicle. We don't provide tax, legal, or investment advice. So it's important that you are aware that you should be consulting with your tax and legal professionals when it comes to using this type of plan. So let me go ahead and pass this information over to Lorraine here. Lorraine, I'll go ahead and take it away. I'll be giving you controls to go ahead and start your presentation. Hold on here. Looks like we have a slight delay here.
Hi.
Okay.
Good afternoon, everyone. And you can hear me. Just getting our PowerPoint up.
Okay, here we go.
All right. Got me on PowerPoint?
Okay. Actually, I do not see your PowerPoint screen. I see it looks like a database screen here.
Okay. Sorry, guys. First time I've tried to import PowerPoints into webinars. I'm a great CPA, but some of this techie stuff gets me Do I need to click something, Lamarr, to get this bring in, or do you want to bring it up?
Okay, let me just try to bring it up on my end here. Hold on here. And just prompt me as you want me to progress through the screens.
Okay, yeah. I've got mine open.
Yeah, for some reason it's not recognizing it on your end, so let's see here.
Huh.
Okay, here we go. And whenever you're ready, just let me know.
Okay. So we're going to be talking very specifically today about the unrelated business income tax and the UDFI, unrelated debt financed income. Be aware, okay, back up one for a second, Lamarr.
Okay.
So the UDFI applies anytime you're using financing inside of your IRA. These rules do not apply to self-directed 401k plans. So when we're talking about anything to do with the financing in the UDFI, be aware that that's only for self-directed IRA plans. And it's not limited to just real estate. It's any time you have any kind of leveraging used inside of your IRA. Okay, so let's go ahead and advance one slide. And the most important thing, as Lamarr tells you, is education. These rules are very technical. You really need to be familiar with them. Self-directing is one of the best ways to get a great return on your investment, get it out of the hands of other people, but you really need to know the rules. So education, 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 and these are key, these presentations. So thank you for coming. Okay, next slide. Let's talk about what UDFI is. So unrelated debt financed income. It's a big word. We have lots of lovely little acronyms in the Internal Revenue Code. But basically, what it means is the percentage of income that you get in your IRA that is relative to how much you have for debt. So, for instance, if you are using 50% of your IRA money to invest in something and 50% of your IRA money is borrowed, the earnings that you realize, only half of it has to do with your IRA money. The other half of those earnings have to do with money that you have borrowed. Because of that, you have to pay an income tax because that money never got in there by a contribution to a retirement plan. So therefore, that's why you have to pay it. You do, however, get to utilize all the deductions you possibly can in order to reduce that amount and make that a little bit easier to live with. You get depreciation, but unlike in a taxable business, you don't get to use the special write-offs, you know, the accelerated 50% or the, you know, taking it all in 1 year. You do have to do what's called a straight line method, which simply means if your asset has a 27-year life, you divide it by 27 years, and that's how much you get every year. As I mentioned before, it does not apply to 401k plans, so this is specifically to IRAs. Okay, let's go to the next slide. The definition is your gross income times what's called your debt basis percentage. A lot of people, when we talk about the UDFI and financing in specifically real estate inside your IRA, and they get a little nervous because they hear, oh my gosh, I have this tax, I have this tax. But nobody really knows how much it is and if it's bad. So this is where we're going to introduce to you the jargon, the definitions, how you compute it, and let you see how much it is so that you can make a really good decision when it comes time to finance or not finance inside that IRA. So your debt basis percentage is what's called your average acquisition indebtedness divided by your average adjusted basis. And I'm going to show you what those numbers are. I have these on spreadsheets for you. These two numbers will change every single year because they're moving targets. Your debt will always change because you have principal payments that you're making on the debt, and your basis is going to change because you're always taking depreciation on the property. So that's sort of how that works. Let's go through an example, and I'm going to go through it slowly and see if we can follow along. Okay, go to the next slide. Here's our facts. We're going to purchase a piece of property inside of our IRA. Okay? The property is going to cost $150,000, and we're going to presume that 25% of that value is attributed to the land and 75% is attributed to the actual structure. And we need that to determine the depreciation. We usually get those numbers off of the property tax statements. You're going to put a down payment of 50%, and you're going to get a loan for 50%. So $75,000 down, $75,000 is going to be a loan. Of course, it's got to be a non-recourse loan, and we're going to assume it's 30 years at 5% interest. All right? Your payment is $4.95 a month. Your monthly rent from the property that you're going to be getting is $1,500 a month. You're assuming we're going to buy it in January. It just makes it easier to do the examples if it's 12 months. Your property tax is $1,900 a year, your insurance $750 a year, and you'll be paying utilities of $900 a year. So those are your fact patterns, okay? And we're going to use these numbers, and I'm going to run you through holding this investment for 4 years, doing the UDFI calculation, and then at the end of 4 years, we're going to sell the property, and we're going to see what your cash flow is, what your total taxes are, and your return on your investment, and how you actually walk through this. So you can use this model to determine if you're making a good investment in your IRA. Okay, ready? Let's go. Next slide. This is where I get to have fun. Don't be scared of the numbers. Okay, column 1 is where we're going to be determining the numerator, the number on top of this percentage. Okay, it's called your debt basis percentage, and this is your average principal. So there's 2 parts. Let me back up. Sorry. The top number is your average principal, and the bottom number is your average basis. Okay, so there's your formula. So let's do the top number. We're going to start with your beginning principal balance on your loan of $75,000. There I've just put the interest and principal payments for the year. That's that $495 a month that you need to pay. And at the end of the year, there's what you still owe on your loan, right? The $73,893. The average, okay, again, you just take the beginning and the ending and add them together, divide it by 2, so you just get what your average is for the year. And you can see that's the $74,446. That's the number that you're going to use in the numerator of your formula, okay? Then your bottom number is over in the column to the right called basis. Here's where we bought the property for $150,000. We're going to take the depreciation on only the structure portion. So remember earlier I told you 25% was land. So we're going to take 75% of the cost, and that's going to be how much we can take depreciation on. For residential rental property, it's 27.5 years. So I'm just going to divide that by 27.5 years, and $4,090.91 is how much depreciation I get every year on this property. All right? So then you do the same sort of thing. You take, okay, here's my beginning basis, and here's my ending after I've taken my depreciation, and I come up with an average. So there's your 2 numbers, okay? So the number on the top is the $74,446. The number on the bottom is the $147,954. Your percentage is 50.32%. So remember when we started, the property was 50% financed. But you can see that your ratio is actually a little bit higher than 50%. That's because the depreciation number is bigger than the principal reduction, so that percentage is going to vary a little bit from the straight 50%. But this is the magic number that you're going to use now to determine how much of your income on your property that year is going to be subject to the UDFI tax. Okay, so let's go to the next slide. So here's just an example of the cash flow in year 1 and actually computing that UDFI tax. All right. Over on the right, you can see we have the $18,000 a month rent. We have the total number of the taxes, insurance, and the expenses. So over here in the finance portion, we simply take those totals and we multiply them times that percentage that we just did in the previous slide. All right. So the amount of rent that are attributable to the debt is the $9,057. Of course, you get to take all of the interest because all of the interest is deductible because it is only the debt. And then you'll take the percentage times the taxes, insurance, utilities, and the depreciation, and those are your expenses for the UDFI. You take that off of your gross rent. You always get a $1,000 exemption every year, so you can get $1,000 of UDFI and pay no tax on that. And so you can see in this example, your UDFI that is subject to tax is only $507. Not such a bad deal. The tax on that is about 76 bucks. All right, I'm not very scared. I mean, you tell me now I have to pay tax in my IRA at $76. Heck, that's lower than the annual fees I probably pay, right? The taxes are computed on the rates for trusts and estates. And I'm not sure if I put that slide in there, so let me tell you what those rates are. They do go up really quickly. So from $0 to $2,450, the tax rate is 15%. From $2,450 up to $5,700, the tax goes to 25%. Up to $8,750 is 28%. Up to $11,950 is 33%. And once you get over $11,950, it's 39.6%. So the tax rate goes up really, really quickly when you're using these rates. Okay. Everybody got that? Oh, wait, hang on. So let's go on the bottom on the cash flow. So this is what you can expect, the return of money on a cash basis that's going to come back into your IRA. So you have your total rental income of $18,000. I took off all of your mortgage payments, the expenses you had to pay, the taxes you paid, and you can see you actually realize a net cash flow of $9,562 for the year on your $75,000 investment. I think that's pretty good. Okay, let's go to the next slide. Now, we're going to go through these fairly quickly because, again, this is pretty much the same thing we just did, except I've just taken it to year 2. All right, so we're going to start with the principal balance on the loan. Again, we'll record our interest and principal payments. We have our ending principal per the loan, and we get our average amount. Same thing with the depreciation, right? You just carry forward the numbers from the prior. You run through the calculation. You get your depreciation, and you get your bottom number. Now you can see your debt finance percentage is 50.96%. So it's actually going up a little bit. And again, that's because your basis is coming down faster than your debt because the depreciation number is bigger. Okay? So next slide. So here's the exact example again in year 2, computing what the tax will be. So you come down through the same calculation. And here, your UDFI is only $630, and your tax is $94.60. All right, this still looks pretty doable. I'm happy. All right, let's go to year 3. You can go one more slide for me. So here's year 3. Again, same thing. Start with the basis. And I have these spreadsheets on Excel. It's actually very simple, but if anybody wants them to use to analyze investments, I'm more than happy to share them with you. So we'll run through, again, the example, and now we're up to 51.6%. So that percentage keeps going up a little bit. If you wanted to make that not happen and have that go down, what I would advise is you take some of the cash flow that you're getting from the property and pay down that principal. That would help alleviate some of that. But you know what? At this tax rate, at $95 a year, I'm really not that concerned. I just as soon leverage that money and maybe have a second property and be doubling up on my returns. Okay, next slide. So here's year 3 in the cash flow. Again, we're realizing $9,500 a year on our investment, and the tax in year 3 is $113. So again, it's very, very doable. Okay, next slide is year 4. And we're going to sell this property at the end of year 4. Okay, so now when we get into this, you can see that your debt percentage is now 52.23%. Your basis in your property is now $133,636, and that's because you're taking, again, the $4,000 every year in depreciation. And I know it sort of doesn't make sense because you say, well, but I'm not really taking the $4,000. I'm only taking half of that because I'm only using that amount as a deduction against my income when I'm doing my UDFI. But you'll see at the end of the example how we average that out to get the taxable gain. So here we are at the end of 4 years. We still owe $70,000 on the loan. We haven't brought it down too much, only about $5,000. And we've brought our tax basis down on our property. And tax basis is merely the number that you use to measure how much your income or your loss is going to be for your taxes. So next slide is our operations. And again, our UBIT tax is, again, $133. Not a bad deal, right? I'm pretty happy still. And we're still making $9,500 a year cash flow on this property. All right, let's go to the next slide and see what happens when we sell this baby. So we're going to make some assumptions. We're going to assume that the property has appreciated, and it's now worth $200,000. So if you recall, we bought it for $150,000, and we're going to assume it's worth $200,000 now. We're going to pay $15,000 of sales costs, commissions, escrow, title, all those normal things when you sell. Our adjusted basis in the property, as you saw earlier, was the $133,000. So that was the cost of the $150,000 that we paid for it, less those 4 years of depreciation we've been taking. So based on those numbers, we realized for income taxes a gain of $51,363 on the property. We're going to get cash out of the deal, which is what we sold it for, the $200,000 less the $15,000 of costs and commissions, $185,000. We're going to go ahead and pay off the loan. Remember, we owe them about $70,000. So we're going to have net cash that's going to come back into our IRA of just shy of $115,000. Okay? So let's go on to the next slide. Now, here's how you're going to compute how much of that $51,000 gain you have to pay taxes on, because remember, that gain, part of it is because of the financing. So what we're going to do to figure out the taxable amount is you have to look back a year and you say, okay, what was the highest amount that I owed on this property in the immediately preceding 12 months? So basically, you're just going to go back to January 1 of the year before and grab the loan balance, okay? So there was the highest amount I owed. Here was my average adjusted basis, okay, during that same period. And here's the percentage of gain that's going to be taxable, 52.7. So we're going to take that $51,000 gain that we just calculated when we sold the property, multiply it by that percentage, and you'll see that the total gain that's subject to UBIT is right around $27,000, okay? That next line, losses carried over, is a 0 in this example. However, sometimes you have losses on your rental property. So sometimes if you calculate, if you had a bunch of repairs or maybe you had some vacancy and your cash flow turned out to be negative, then you do get to carry those losses forward, and we would use that to offset some of this income. So you want to keep track of that every year. Even if you don't have the UDFI, you want to keep track of the operations, because if you have losses you haven't used in the past, you can use them now when you sell the property and reduce the amount of tax you're going to have to pay. Okay, on the next slide. So here is just pretty much a synopsis for you of this investment, what your cash flow is, what your total taxes were, and sort of how you made out on the deal. This is important information when you're analyzing your investment and deciding, you know, do I want to finance? And if I do, how much is this going to cost me? And what's going to be my ultimate return? So what I've done is I've put the cash flow for the 4 years up there, and I also put in the cash that we got when we sold the property. I subtracted the amount that we had to put down. Remember, we put $75,000 down initially. So our net cash profit is just shy of $78,000. The taxes we have to pay on the capital gain, because you know what? You get capital gain rates over here inside of this IRA. Just because those rates go up really high, we still get to take long-term capital gain on this, and I've estimated that to be 20%. Those rates change. Sometimes they're 15, sometimes they're 20. I went ahead and used the highest rate for this example because the numbers only get better if you take a less amount. But let's show you the worst case scenario. So at 20%, you're going to pay UBIT taxes on the sale of that property of $5,400. That's not too bad. You made a $50-some-thousand gain, so it's about 10%. So your net cash flow on this investment, you invested $75,000, right, 4 years ago when you bought this property. You had cash flow of $72,000. After 4 years, you've now got $147,000 in your IRA, and you paid total taxes of the UDFI over the 4 years of $5,830. I think that's a pretty good investment. You've doubled your money in 4 years, and you only paid just shy of $6,000 in taxes. So armed with this information, the next time somebody says to you, sure, you can buy rental property inside your IRA, and yeah, if you want to go ahead and have a loan on it, you're going to have to pay taxes. Instead of shuddering in your boots and not knowing what you're talking about and maybe shying away from it, you could say, oh, heck yeah, I'm fine. This is like great. I don't mind paying this kind of taxes for these kinds of returns. Because what you'll do, instead of taking the $150,000 and buying one property all cash in order to avoid the UDFI, you can buy 2 properties and leverage it, and look what happens. You've made so much more money, and avoiding the UDFI is really not an issue because I don't think it's a substantial amount of money compared to what you're getting on your returns. So based on that, I would finance all day long if I had rental property in my IRA. So that's a little bit complicated, all of these numbers, but hopefully you were able to follow through how it's calculated and how to determine. Now these numbers, of course, will change if you do, for instance, a 65% loan to value or a 30% loan to value. These numbers will change. As we mentioned, or I mentioned a little bit earlier, if you pay that principal down, so if you can manage to get that principal paid down before you sell this property, and specifically a year before you sell the property, because remember you have to look back for the 12-month period. So you can't just pay it off, 3 months before you're going to sell it. In other words, borrow some money from somebody, pay that thing off really quick, and then pay them back. That won't quite work. You need to go back and actually have it for 12 months. But you can avoid the UDFI on the sale if you pay that mortgage off 12 months before you sell your property. So that's one way to get out of this, if you can manage to do that. Okay, let's go to the next slide. So let's talk about UBTI for just a second. So the UDFI, unrelated debt financed income, actually comes under the same umbrella of UBTI, which means unrelated business taxable income. So the rate is the same. The calculation of this income is a little bit different, and let me tell you what the UBTI applies to. So anytime you have a trade or business that's carried on inside your IRA that is not related to the IRA's tax-exempt purposes. So when you're looking at a normal charity, you might look at a church or something and say they have a little business on the side. That would be taxable to them. Inside an IRA, however, because, what is the tax-exempt purpose of an IRA? Well, it's to grow and, give you retirement money. But according to the IRS, any active trade or business that's inside of your IRA is going to be determined to be unrelated to the purpose and therefore will have UBTI. These rules also are going to apply to your 401k plan. So going forward, everything I'm talking about now applies to your IRA and your 401k. So anytime you have a business inside of your IRA or your 401, there is going to be the UBTI. Well, what's that look like, and how do we calculate that? Let's go to the next page. So here's an example, just a quick one. Let's say that your IRA owns a business, like a restaurant. I like to use a sandwich shop. I don't know why it's my favorite example. And keep in mind, if your IRA owns a sandwich shop, you can't work there. You can't manage it, and Lamarr will get into that in the second part of this. That's prohibited. You're not allowed to do that. So you may go ahead and invest in a business and have the business operate, but you cannot be working there. So all of the income is going to be subject to the taxes. The computation is pretty complicated. I'm going to touch on it and just describe it a little bit. But before I do that, let me tell you the reason we have the UBTI. So we don't want a business to have an unfair advantage over other businesses. So my sandwich shop example, let's say that you have a sandwich shop and you have to pay taxes on it because you don't have your sandwich shop owned by your IRA or your 401k plan. So I have to pay taxes, and I have to build that into the cost of my sandwiches. So let's say there's a sandwich shop across the street, and they have theirs inside their IRA. Well, they don't have to pay taxes, so they can sell their sandwiches for a lot less than I can sell my sandwiches, and they get a little bit of an unfair advantage over me. So what the IRS has done to equalize the playing field is they invented these UBTI rules that say, no, you have to pay taxes too, Mr. Sandwich Shop across the street, because it's not fair to the other guy that you can charge less just because you don't have to pay taxes. So we're going to charge you taxes too. So that's where these rules come from. So what you have to do, it's a little bit complicated, particularly if you've got your IRA or 401k doing a number of different activities. So you've got to, first of all, segregate what is your business income. How much of the income that you're getting is truly just from the business that you're operating and not from other things. So not the rental property, not the interest income, not the dividends, none of that stuff, only the income that's from the business. And then you're going to have to reduce that by the allowable deductions. So the allowable deductions are going to be the ones that are directly connected. And now what you do is you have to jump back over into the other income tax rules and say, well, if this thing was a corporation, what do I get to write off over here? And so you have your expenses that would clearly be directly connected. So in my sandwich shop example, the rent on the shop, the salaries you pay the employees, the cost of the bread, the insurance, all of the costs that you have, those would come off of the income in making those, making the determination. But you also get some other things. You're going to get depreciation and charitable donations and interest expense and all of the other expenses that you would get as if you were running this as a fully taxable corporation. So you've got to go through all of those rules and all of those computations and do the allocations to come up with what your UBTI is going to be. The downside of that, of course, is they're going to be taxed at that higher tax rate. You don't get to tax those at the corporation tax rates just because you use those rules to come up with those amounts. You don't get to use those tax rates. So again, as soon as you get over about $12,000 of income, taxable income of UBTI, you've got to pay 39.6%. So when you're running a business, you really need to run those numbers and make sure that it makes sense to pay that tax, because that is a pretty steep tax to have to pay. One of the reasons you might consider doing that is perhaps the income is going to be a little bit low, it's a startup company, or you're willing to go ahead and pay the tax because you're hoping at the end of the day, when you sell that company and you sell that stock, that the value has gone up so much that you're going to make a killing in it, and you don't mind that you had to pay this UBTI on the business, because hopefully you'll get capital gain when you sell the stock of that business, which is definitely a fair deal. So you need to know these rules, sort of analyze the entire investment, make sure that it makes sense to you to have to pay this tax. Okay, how do we pay the tax? Next slide. So let's say that we have our rental property or we have our business, and now we need to actually give the IRS the money. How do we do that? Well, there's a form. Of course, there's a lovely form in 990 T like Tom, and it's about a 5 or 6 page form that needs to be filled out. It's usually due by April 15th for IRAs. Your IRA needs to have its own tax ID number, and when you set your IRA up, they do give you your own tax ID number, and that's the number that goes on the form. And be aware that your custodian does not do these for you, okay? They will do some of the tax reporting that needs to go to the IRS, but generally they do not do the UBIT and the UDFI calculations or the tax. So they won't give you tax advice on it either. They're not allowed to give you tax advice. They can steer you in a direction where you can get some help. So you need to either know these rules and know how to fill out those forms yourself, because it's going to fall on you, or you're going to need to find somebody like myself who knows how to do this stuff. And I would be armed with information, education, when you're interviewing people to help you do this. Make sure they know how. Make sure they know the rules, because it is a little specialty niche, and not everybody knows how to do this stuff, okay? So the better you know these rules and the more informed you are, the easier to stay out of trouble. There's some information on the IRS's website that you can get on this. It's sort of hard to digest it, so I do advise that you get some help. Okay, that pretty much is what I have on the UDFI and the UBIT. If there's any questions, like Lamarr said, you can type them in. Feel free to email them later. Every situation is unique. Everybody's circumstances are different, so it's really difficult to just give blanket tax advice out. You really need to sit down and look at the particulars of every situation and make sure that you get the right advice for your situation. Okay? So that's
okay.
what I have. Thank you very much for listening. I hope this was helpful to you.
Thanks a lot, Lorraine. I think you shared some very valuable information, and it's ironic that we're actually doing this webinar today, considering I had a client just a couple of days ago who was looking to move her account from a traditional custodian over to a self-directed plan, and for whatever reason, the custodian, the current custodian, basically told her that one of his apprehensions as far as her moving the funds over is that if she doesn't have enough money and she has to obtain a non-recourse loan, that UDFI would apply. And of course, anytime someone is assuming that they have a tax-free or tax-deferred retirement account, the last thing they want to hear is that there's additional tax they may be subject to when they're supposed to be in a tax-free environment, as when they're in the middle of investment. So I will definitely be forwarding her a copy of this webinar for her to review, as well as to review with her tax professional, as well as this financial planner advisor, so she can make an informed decision as to whether this is for her when it comes to opening a self-directed IRA using a non-recourse loan. One of the things that's really important, I think, that you covered was part of your due diligence is to crunch the numbers. As Lorraine mentioned, is that it's really important that you factor in any potential UDFI or UBIT into your transaction. For the most part, because of the deductions that you can't take, a lot of times if it's properly calculated, you will find out that the tax may be either non-existent or very minimal. So definitely do your research, crunch your numbers to make sure before you move forward that it does work for you. When it comes to a non-recourse loan, LTV does play a role, so usually the lower the LTV, the better. Most cases, most of the clients that are using a non-recourse loan and are subject to any type of the UDFI, the loan to value usually are 65% or less. So just keep in mind, the higher the LTV, which means the loan amount is going to be a lot higher, that the higher the UDFI tax will be. So what I'm going to go ahead and do is talk a little bit about the self-directed IRA and try to tie some more of this in terms of when does UDFI and unrelated debt finance income tax and unrelated business taxable income would apply. I'm just going to talk about some of the different aspects of the self-directed IRA, such as the prohibited transaction rules and so on and so forth. That's also important in addition to using a non-recourse loan or using your self-directed IRA to invest in businesses where the two taxes may apply as well. For those who joined late, my name is Lamarr Baxter, the Director of Business Development for AccuPlan Benefit Services. Here's my contact information, and I forgot to actually add Lorraine's contact information onto the PowerPoint. So anyone who has any questions or any inquiries they want to direct over to Lorraine, feel free to email them over to me, and I'll promptly forward that information over to Lorraine for her to get back to you. So I'm just going to go ahead and talk about the self-directed IRA. And before I get started, for those who had joined the presentation later, I'm just going to read off our disclaimer once again, because once again, we do not provide investment advice, tax, or legal advice. It's really up to you to consult with your tax and legal professional before making any investment. So with that being said, AccuPlan Benefit Services and its affiliates do not provide investment or endorse any products. All information and materials are for educational purposes only. All parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. The AccuPlan Benefit Services is a national company. We specialize in the self-direction of IRAs and 401ks. We provide both custodial as well as administrative services, in addition to some other services that basically go hand in hand with the self-directed plan, such as setting up a checkbook LLC and some of your business trusts. We pride ourselves in our expertise in low cost and quick service for the self-directed IRAs and 401ks. We have a very well-versed staff and experienced staff. Actually, the head of our compliance department is an ex-IRS auditor, or should I say be the head of an ex-IRS auditor for for the IRS, and was actually with the IRS for like the last 30 years before retiring and joining AccuPlan. So when it comes to information relative to Internal Revenue Code 4975, we have up-to-date information because our head guy in our compliance department is on a regular basis conversing with those over at the IRS to make sure that any new changes as it relates to laws that applies to self-directed plans, that we're well versed. And our objective is to make sure that any transactions that come across our desk are compliant, to make sure that you don't have any taxable events as a result of a prohibited transaction. So one of the things I like to mention is kind of go over some of the reasons why the self-directed plan is actually becoming real popular. It's estimated as 10,000 baby boomers will turn 65 for the next 20 years. Up to 75 to 90% of that population do not have the resources to retire at the age of 65 and beyond. Most will be forced to continue working beyond the age of 65 due to retirees facing skyrocketing health care costs and diminished Social Security benefits. Benefits that were around 2-3 generations ago may not be around moving forward, so it's really important that we take a proactive approach in understanding what's ahead for us and to take an aggressive but at the same time safe approach when growing our retirement account. Inflation and cost of living increases will definitely play a part in eroding our fixed incomes at retirement age, so it's definitely important that we look at both safe as well as aggressive retirement avenues, and this is where the self-directed plan comes in because of the alternative asset classes that's available that may not be available or usually not available with traditional custodians. Investing in real estate is one of the key asset classes that most of our retirement account holders are taking advantage of, whether it be investing in real estate directly, indirectly, and when we say indirectly, some are actually using their IRAs and 401ks as a source of capital to loan money out secured by a first, second, or third deed of trust. So you do have some definite options when it comes to that. Over $4.7 trillion in combined IRA and 401k funds are basically out there in retirement plans, with only 1% invested in self-directed retirement accounts. So we, as the U.S. public, definitely need to increase that 1% of our assets to make sure that we have a truly diverse retirement portfolio, to make sure we can hedge against any losses that we may sustain as it relates to traditional investments in the stock market. $750,000 to $1 million is the amount needed to sustain in retirement years. So what does that mean? $750,000 to $1 million, depending on where you live in the U.S. That is what they're saying that is needed at retirement to be able to sustain you through retirement years. So this is where you really want to sit down with your CPA, your tax planner, or financial planner and find out what are your goals, short-term and long-term, as it relates to retirement. Because once again, if we're looking at these numbers here, $750,000 would more likely be the average throughout the U.S. And if you're looking at certain areas such as New York and California, is more closer to the $1 million based on the cost of living in those states. So it's really important to take a note of that. They say up to 90% of the population is unaware of self-directed IRA exists. And that also would include some of your planners and advisors, accountants and attorneys. And what the reason is most of them are not aware, because not everyone specializes in that segment of the tax code when it comes to self-directed plans. So it's really important that you consult with someone who's knowledgeable and can give you accurate information as to how the plans work, what the rules are, because I know there's a lot of negative information out there for those who do not want you to move your funds over to a self-directed plan, either because they're going to lose a commission or either because they don't understand the plan. But the self-directed plan has been around since 1974 as part of the ERISA Act that was passed in 1974 that allows for the self-directed IRA or 401k to exist. So this is not a new concept. It's been around since 1974. Once again, if you were to do any research, you can Google ERISA Act of 1974, and it'll basically outline when this plan was actually instituted and available as per passage by the Congress back in 1974. And so your current custodian may not offer what's called a truly self-directed IRA. Their definition of a self-directed IRA means that you may have 15 to 20 options within the portfolio that they have, but a truly self-directed IRA will give you the option to invest in both traditional and non-traditional investments. What that means is you're able to invest on Wall Street as well as invest on Main Street. The only two restrictions you have with a truly self-directed IRA is that you cannot invest in life insurance or collectibles. And we'll talk about that in future slides here. Diversification is key. Over $4.7 trillion in IRA assets, most are invested in Wall Street. So once again, we definitely got to start thinking outside of the box and truly diversify investment portfolio. The majority of those funds are invested in some of your traditional investments such as mutual funds, CDs, annuities, and so on and so forth. Nothing wrong with those investments, but in the event of another downturn as we experienced in 2007, there's certain alternative asset classes that may offer you some type of protection in terms of the more significant loss that most of us have sustained back in 2007, 2008. And once again, 1%, less than 1% of the $4.7 trillion is invested in alternative assets. So once again, we definitely need to increase that number within our portfolio. Invest in what you know and understand. So what we mean is we like to believe that everyone has the education and or niche or the know-how to invest in some of your asset classes outside of Wall Street. And these are some of the more common transactions that come across my desk, but of course this is not limited to these transactions as displayed on the screen here. Real estate, as I was mentioned earlier, is one of the #1 asset classes that most of our clients are taking advantage of and investing in with their self-directed plans. Precious metals was pretty hot up until say about 2010. Private notes and loans. As I mentioned, you are able to invest with your self-directed plan, either secured or unsecured. There's different structures, and when we say unsecured, most custodians have pulled back from offering unsecured notes as an option, but of course through an LLC structure or checkbook right control feature within your plan, you may have that option to do that. For more information on it, please give me a call and I'd be happy to discuss how that would work. But for the most part, you can grant loans from your IRA secured by either real property, UCC1, and other instruments. For the most part, most custodians do require some form of security or collateral attached to the loan. Private companies. There's a lot of capital, a lot of companies out there that are starving for capital right now, and a lot of not able to obtain capital through traditional sources such as banks, especially if they're a startup company. There's a recent passage of crowdfunding that's basically a lot of organizations that are popping up that are looking to aid companies or organizations in terms of raising capital through private sources. The self-directed plan will play a critical role in terms of crowdfunding in the coming years. So this is once again another avenue that's in conjunction to the self-directed plan that you're able to take advantage of, that you're not able to take advantage of using a traditional custodian. So as I mentioned, the only limitations of life insurance and collectibles, these are just some of the investments that I've seen nationwide that have come across our desk. But once again, if you kind of look at this list here, I'm sure if you were to contact your current custodian, these investment options would not be available to you. You must have a self-directed plan in order to make these types of investments. Prohibited transactions. This is part of the Internal Revenue Code 4975, and basically what that basically states is that there's certain restrictions you have with the self-directed plan do's and don'ts. So what this says in summary is an IRA cannot engage in any transaction, direct or indirect, with anyone or anything considered related to the IRA. So for example, a prohibited transaction between a disqualified person, and we'll describe who a disqualified person is in the next slide. So for example, any prohibited transaction would consist of a disqualified person in an IRA in the engagement of selling, exchanging, or leasing property, lending money, or extending credit, furnishing goods and services, and or facilities. If the person that you're doing business with or your IRA is doing business with is not a disqualified person, these transactions are fine. The key here is not to conduct transactions or business with any disqualified person. Two key points with the IRAs is no self-directing or no self-directing involving disqualified persons and or self-dealing. So you cannot take personal possession or personally use any of the assets held by your retirement plan. It has to be distributed out of the plan in order for you to take possession, of which it will be treated as a distribution and taxed at ordinary income. And if you're under the age of 59 and a half, an early distribution penalty would apply. If you have any questions on that, feel free to give me a call, and I'll be happy to go into more detail in terms of how that rule works. So just to give you an idea in terms of when you're looking to put together your transaction, who's a disqualified person. An example of disqualified persons would be you as the account holder and your spouse, any lineal ascendants and their spouses, any lineal descendants and their spouses, any fiduciary of the IRA. So if you're an attorney, CPA, accountant, real estate professional looking to engage into a transaction with the account holder who's also your client, then you as the fiduciary would be considered a disqualified person. Now, if you're performing services outside of the transaction, your fine is that you cannot partner with that IRA holder because of the influence and the fiduciary capacity that you have over that client. Anyone providing services to your IRA, so that would include myself if I was looking to partner with an account holder because of me providing a service through the custodial service and administrative services through AccuPlan, I would be considered a disqualified person. Corporations and partnerships, trusts, and other entities in which you own directly or indirectly at least 50% or more are controlling interest in that organization. That 50% would also count as it relates to both you and your spouse combined. So it could not be where you own 49% and your spouse owns the other balance of the ownership in the company. If you and your wife combined owns more than 50% ownership stake in that organization, you cannot do business with that organization if you own it. So in essence, basically, when you look at Internal Revenue Code 4975, you do not want to take any shortcuts or cut any corners because they are basically turning over every rock to basically see if there's any tax cheats out there, and they are looking at self-directed plans. So it's not worth it based on what the penalties would be. So once again, the penalties would be a distribution, the entire amount, not just the amount involved in the prohibited transaction. Your entire account would be considered disqualified and taxed at ordinary income. If you're under the age of 59 and a half, the additional 10% early distribution penalty would apply. So once again, it's not worth it in terms of trying to cut corners and breaking the rules. So how do you actually fund your IRA, putting cash into the account? These are the four methods in terms of getting funds into the account. Real quickly, the transfer is the method of basically transferring funds from one IRA to another IRA. So if you have funds with your traditional custodian and it's an IRA, you want to transfer it over to your new self-directed IRA. There's a transfer request that is completed by yourself, authorizing us to initiate the transfer request from your existing custodian over to your new plan. Usually the transfer process takes 7 to 10 business days. The rollover is usually involved in terms of a 401k or an employer-sponsored plan where the funds usually are rolled over within 7 to 10 business days as well. Sometimes the period could be a little bit shorter depending on the custodian. But in the rollover, you have 60 days, whether it's direct or indirect, in terms of getting those funds from the existing custodian over to the new custodian. In most cases, the custodian will cut a check payable to either you or to the new custodian. The check will be mailed to you as the account holder, and you will then forward the check over to us. And the reason being is in most cases, these checks are lost because the clock starts ticking from the time that the check leaves that organization. They don't want the headache of having to put a stop payment on the check and reissue the check and basically start the accounting process and the IRS reporting all over because of the 60-day period. So in most cases, they will always mail the check payable to the account holder, which within that 60 days, you have the responsibility of getting it to another retirement plan to avoid taxation. The contribution will be relative to the type of plan that you're eligible for or that you select, up to that full maximal contribution limit for that plan, and we'll talk about that the next slide in terms of which plans that are available to you based on whether you're 1099 or W-2 or self-employed. Conversions, and that's where you're basically moving funds from a tax-deferred account such as an IRA or 401k over to a Roth. You will be subject to taxation at that point of moving those funds or converting those funds over to the Roth account. And one of the benefits of the Roth is that if you're looking to move your funds from a tax-deferred account over to a Roth, as long as you've had the account for 5 years and you're over the age of 59 and a half, any growth that you realize after meeting those two milestones, you pay no tax on the growth within that IRA. So that is something based on the uncertainty where we're going to be moving forward in terms of taxation in the U.S. A lot of our clients are looking to convert either portions of their funds or all of their funds into a Roth account. So these are the type of plans that are available through a self-directed plan, through AccuPlan. You have the traditional IRA. Maximum contribution limit is $5,500. Once again, this is a tax-deferred account. If you're over the age of 50 and a half, you have a catch-up provision of an additional $1,000, which allows you to contribute up to $6,500 per year. The Roth, same contribution limits. The difference between the traditional and the Roth is that this is can grow, your retirement account can grow tax-free as long as you've met the 2 milestones of having the account for at least 5 years and you're the age of 59 and a half or older. A SEP IRA is more of an employer-sponsored plan, or an employer plan for those who are either self-employed, 1099, or independent contractors. It's a more simplified version of a 401k, where in most cases, once again, you have to be 1099 or self-employed to be eligible for this type of plan. The contribution limit is up to $51,000. There is no catch-up provision for the SEP IRA. Once again, these limits I'm mentioning are up to. So it's really important that you consult with your tax professional to determine what is your modified adjusted gross income to make sure what your maximum contribution would be up to these limits on these plans. The simple IRA is for those businesses that has less than 100 employees. So if you're looking to get a simple plan other than a 401k, a simple IRA is another option that's available to you, and the contribution limit on that is $12,000. The more popular plan, and this is something that ties into what Lorraine had talked about when it comes to unrelated debt finance income tax, the 1K, 401k, or solo K is a plan for those who are 1099 or self-employed, and for those who are general partners in a business, whether it be a husband and wife or a general partner, you're eligible to open up this type of plan. And it does have a Roth component, whereas you can contribute to this plan up to $51,000. A portion goes towards the 401k, the other portion goes to the equivalent of what's called of a SEP IRA, or if you want, you can opt to take advantage of the Roth component offered with this plan. If you want more information on how that plan breaks down and how it works, please give me a call. I'd be happy to answer any questions on that. So, in summary, this is pretty much what we're talking about in terms of the self-directed plan. The checklist here in terms of getting an account established, first of all, you want to establish your self-directed account, especially if you're going to get a non-recourse loan. And once again, this ties into what Lorraine was talking about earlier in terms of the UBIT. And we're actually going to be talking about a non-recourse loan in more detail on the next webinar, which is going to be held 12 noon next week at August 15th, with organization First Western Federal Savings, which is a non-recourse savings and loan institution that grants non-recourse loans to self-directed IRA holders. And he'll talk about what's required in terms of qualifying for a non-recourse loan, what are some of the underwriting guidelines, some of the information that's just really important for you to understand if you're shopping around for a non-recourse loan, the rates, the terms, so on and so forth, will be covered in this webinar. So it's important that if you are interested in a non-recourse loan to definitely log in or send me an email requesting a registration for that webinar, because once again, the information that Lorraine shared with you today will definitely go hand in hand with the information that will be covered on that webinar. So back to the list here, providing a lender with an IRA vesting and proof of funds for underwriting and approval. So there's going to be a checklist of items that's going to be required in terms of obtaining the non-recourse loan. So you're going to have the documents that you're going to have to complete on our behalf, as well as documents for the lender. So once we receive all of those documents, at that point you would have already more likely entered into a purchase contract under your legal IRA vesting. Once again, it's important to open and establish your account in order to receive the IRA vesting, in order to, first of all, even qualify for a loan or even contact the lender for a loan, because one of the things they're going to ask you is, have you already established your account? You're going to have to show proof of funds and a host of other items as it relates to applying and getting approved for the loan. So definitely get the account established. So step 5 here. All the documents will be forwarded to title and escrow, including the escrow deposit based on whatever the contract outlines in terms of the escrow deposit. Once again, let's see, section 6 here, or item number 6 here, you're going to complete our internal authorization forms as part of your packet. And once those documents are completed and signed, usually within 3 business days of a complete packet, we can actually fund the transaction for your transaction to close as it relates to the entire real estate transaction. So that's pretty much what we have to cover for today. I'm going to open this up real quickly for a Q&A session here. I know there's questions that have already started to come over, and look like most of them are directed towards Lorraine based on what she covered for her section of the presentation. Let me go ahead and read the first one here. Hold on, let me open up here. And I'm just going to leave my contact information up here for you if you have any questions, and or if you want to email me information to forward over to Lorraine and get you her contact information. I'd be happy to get that over to you. So the first question is, does UDFI apply to rental income? I'll go ahead and let Lorraine answer that question.
No. If you don't have any financing on the property, then the UDFI does not apply to rental income. Only if the rental income is part of a trade or business that you're running. So maybe if you are subleasing out an office space and you're a nonprofit, but no, generally that would be no. Does not apply to rental income.
So if a client has, or so the IRA has a non-recourse loan and they're collecting rental income, I think it's more or less where that question is going. So there is a non-recourse loan tied to the transaction, and they have rental income. Do they pay the UDFI tax on the rental income that they receive throughout the year, or do they wait and pay everything once the property sells?
It goes every year. You need to do those calculations every single year on that rental income to see if you're subject to the UDFI tax. You need to do, like I had on the spreadsheets, you need to run those numbers every year.
Okay. Next question is, when is the retirement account exempt from UDFI or UBIT?
When it doesn't do those things.
Okay. Why does UDFI apply to non-recourse loans? I know you explained why it applies to, why UBIT applies, but why does, the question is, why does it apply to non-recourse loans?
Because you're making money inside your IRA that has nothing to do with the money that you contributed to your IRA. So it should not be tax exempt because it has nothing to do with money that came into your IRA by IRA contributions. It's money that came in from borrowed money, so therefore it doesn't get treated the same.
Okay, and for those on the call still, so basically, for example, if it's a $100,000 transaction, $50,000 was IRA funds, the other $50,000 is from a non-recourse loan. If it's a tax-deferred account, 50% of the profits will go back into the IRA tax-deferred. Keep in mind, the other 50% were not IRA funds, so at some point, because you don't have tax-exempt status on a loan, you definitely would have to pay taxes on any profits derived from the percentage of the funds used to acquire the property from borrowed funds. Let's see, the next question here. Which retirement plans are exempt from UBIT and or UDFI? And I think I just covered that. If when it comes to a solo K or employer-sponsored plan, that would be the type of plan that, in terms of UDFI, not UBIT, would be exempt. If you have an employer-sponsored plan or 401k, would be exempt from unrelated debt finance income tax, but it would not be exempt from UBTI. Is that correct, Lorraine?
That's correct.
Okay. And say, when is the tax UBIT paid? So basically you said April 15th is when the UBIT as well as the UDFI tax has to be paid and has to be filed via 990T. Is that correct?
Well, yes and no. So the tax return is by April 15th. You can get extensions, but if you think you're going to owe it, you're actually supposed to make quarterly payments just like you would on your income taxes, or you'll have a penalty for not paying it on time.
Okay. One of the questions, and I'm not surprised this one pops up, but it pops every time this topic of UBTI comes to play, is when it comes to buying and flipping properties, can you go into detail as to when, if someone is buying and flipping properties in the IRA, how many properties would constitute UBTI, and when does it apply when it comes to buying and flipping properties in a self-directed plan?
You know, that's a great question, and there is no black and white answer. And I tell my clients, you don't really want to be the test case, do you? So my advice is mix it up. Don't do too many. There is no black and white rule. I cannot sit here and say you can flip 3 and you won't have it. There is no rule. Every case is facts and circumstances. So it hinges on when are you considered to be a dealer, and when you're a dealer, it's now considered to be business income. So you need to examine the rules that surround when does my buying and selling of property become a business and I am now a dealer. So it's the same rules, you have to look at a number of factors. You know, what's the total income? What percentage of income in my IRA is from flipping properties versus loans and rentals? How often am I doing it? You know, basically, if it starts to look like a duck and quack like a duck and has, you know, flopper feet and a tail, and then it's going to be a duck. So there's no black and white answer to this, but you really have to be careful. I advise people don't even do it. To be safe, just try not to do it at all. Again, you don't want to be the test case.
Okay. Well, look like we have room for one more question, and I'm going to read this one off here. It says, are the tax rates on UDFI and UBIT the same? Are the tax tables the same?
Yes. They're the rates that are used for trusts and estates, and they are the same rates.
Okay. Well, it looks like this, pretty much all the questions we have, time we have for questions. Any additional questions you guys may have, please feel free to give me a call, send me an email. Any questions relative to the content that Lorraine had covered, I'd be happy to forward those questions over to her, as well as to forward you her contact information. Just to kind of give you an idea, most of my clients over this past 6 years that I've known Lorraine will definitely consult with her when it comes to questions that they may have as relates to structure and whatnot in terms of a self-directed plan. You may have a tax professional currently that you're working with, but once again, everyone has their own niche, and as Lorraine mentioned, certain areas of the tax code are kind of niche areas for certain tax professionals. So you definitely want to make sure either your current tax professional is well versed in this area, or to consult with someone like Lorraine. Definitely do your due diligence on any investment. And when it comes to structuring your investments, give me a call. I'd be happy to let you know what you can and cannot do in terms of prohibited transactions as it relates to UDFI and UBIT. You definitely want to consult with Lorraine. Once again, she's an excellent CPA, and most of my clients here in Northern California uses her. So I don't do this on an occasion. Occasionally, I will basically refer clients over to certain professionals, but Lorraine has done such a great job. I'm not reluctant to refer clients over to her. So if you have any questions and want her contact information, feel free to give me a call. Here's my contact information here. I'd like to thank everyone for joining today's webinar. As I mentioned, today's webinar was recorded. In the event you were not able to listen to the webinar in its entirety, I'll be sending out a playback link within the next few days. Feel free to pass that along to others who are not able to take part. And everyone have a great day, and thanks again for attending. Thank you. Thanks a lot, Lorraine.
Thank you. Have a great day, everyone.